everyone. We are back with Building the Wealth. Today, we're going to be discussing how to become an automatic millionaire, and I am your host, Zuleyma. And before we get started, I want to always thank WYTV7 for having us and hosting our program here on their website. Let me go ahead and share my screen so we can get started. I'm going to try to take it a little slow this time around because the information we have today is very, very important. So if we don't finish our slideshow, we're going to leave it for next time. But the idea is to get this information out to you to ensure that you're able to handle your money and become an automatic millionaire once you retire. But before you get to that part, I think it's very important to get the basics down. So we're going to be talking about saving and investing. So before you consider starting investing, there's some things that you have to consider. So how accessible do you need your money to be? If you need your money within a few years, you do not want to invest that money. You want to save it because you want it to be liquid. That means that you want easy access to that money. And when you're investing, you got to think long term. So if that money that you're going to think of putting into investing is going to be needed within the next few years, it's better to save it in a high yield banking account. Okay. So the second thing you have to consider when thinking about either investing or saving is how fast do you want your money to grow. So when you're saving, the return that you're getting on your savings account tends to be lower than what you would get once you invest that money, either in stocks, bonds, or in index funds. So if you want your money to grow faster, investing is the way to go. Number 3, can you afford to lose some, all, or more of your initial investment? So when it comes to investing, you have to keep in mind that there is some risk involved. If people are telling you, oh, invest on this, there's no risk, high return, then that probably is going to be a scam. What tends to happen is that there's a relationship between risk and reward. That means that the higher risk you take, the more reward you will get. The lower risk you take, the less return you will get. That's just how it works in the market. So again, if you have to keep this in mind, if you cannot lose that money that you're planning to invest, it's better not to invest it. If you need those $1,000 by the end of the year, you can't afford to lose it in the market, then keep that money in a savings account rather than try to invest it. Number 4, how does inflation, taxes, market conditions, and other external factors affect your account? So you have to understand some basic economics when it comes to investing to be able to feel comfortable with it and to be knowledgeable about it. So how would inflation affect your stock price, bond price? How do taxes come into play later on? If you're getting a return in a brokerage account versus a Roth IRA or 401k, do you have to pay taxes? Market conditions. What kind of market conditions are going to make your market portfolio go up or down, right? So knowing this kind of stuff will help you. It's more about the emotional aspect of things. So it will keep your emotions on check because you know what's going on. You know what's moving your account up and down. So that means that you're less likely to do something that is not good for your portfolio long term. So understanding how external factors affect your investment portfolio is important just for the emotional aspect of investing. So those are 4 things you have to consider when deciding whether to invest or save your money. And here's some more factors when it comes to saving. So when deciding to save money, this means that that money is for short-term goals. So it includes like having an emergency fund, car fund, vacation fund, or any other fund. So these are short-term goals, and it's best to have this money, again, in a savings account that has a high yield, meaning a high return. Right now, we have looking at like 4% return currently. It's 2023. I don't know, that would change later on. Before this year, it would go down to like 1%, even less than 1% when it comes to savings account. So the high yield accounts right now that we're looking are pretty historic. So you get a good return even in your savings account currently. When looking again at low risk, low return accounts, those are your high yield savings account and your certificates of deposit. So that's where you want to have your money that is for short-term goals. Now for investing though, so money that you're going to invest is money that you're not planning to use anytime soon. So you're looking for long-term goals, 5 years or more. Again, some of the low risk, low return accounts are going to be index funds. They're going to be like dispersing your money to different kind of stocks and bonds and RETs, but you're also going to get lower return than to an individual. But you have that security in mind. If you're more like a risk taker, you might want to go for individual stocks and individual bonds. But if you're maybe a low risk taker, index funds might be better for you. But again, remember that relationship between low risk and low return. So here we have like a little activity that we're going to do. So choose to save or invest. So we have different financial goals on your left side, and then we're going to decide whether we're going to save that money or we're going to invest that money. So we have to build an emergency fund before the end of the year. Is that a save or an invest kind of situation? Now, again, emergency fund, we're looking at before the end of the year. So it's probably a savings account kind of type of money. So we're going to put that in a savings account. Now, the second one is have a down payment for a house in 10 years. There's a long-term goal for your money. We're looking at 10 years. So this money maybe invest, right? Because it's a long-term kind of commitment. Number 3, buy a recently released video game system in 6 months. So you're trying to save up, and within 6 months, that money is better kept in a savings account. Number 4, open a retirement account to help you retire in 40 years. Again, looking at that time frame, here it is 40 years. So the money for this one would be probably best in an investment account. Next, we have a down payment for a car next year. So again, we're looking at a short-term goal. We're looking for that money to be able and accessible for next year. So in that case, a savings account may be best. Now, to build wealth over your lifetime. Now here we're talking about your lifetime, right? We have 30, 40 years to go, probably even more. So for that one, we're probably going to be best served in an investment account to get your money's worth. So those are some of the examples we have when it comes to saving or investing. Now, some words to know, invest. So what does investing actually mean? So investing means to commit money to earn a financial return. The strategic purchase or sell of assets to produce income or capital gains. Basically, when you invest, you're expecting to get some money back for your investment. If you put $10 in, you're expecting to get maybe $11 back, right? Get that one difference. And that's how you get some income or some capital gain through that one difference that you see there. Now, what's an investment? So an investment is something you spend your money on that you expect will earn a financial return. Investments, it can be pretty much anything that you can get a return on. If you buy a car and you're planning to sell it for a profit, that's an investment. If you collect Pokemon cards and you expect to sell them in the future for a profit, that's an investment. If you buy stocks, index funds, and you plan to sell them or gain some money through dividends, that's an investment. So you're looking at anything that will probably give you some money back more than what you already invested in, right? What you paid for it. Now, inflation. So inflation occurs when the prices of goods and services increase over time. The importance of inflation is that as your money grows in your portfolio, you have to keep inflation in mind, because $1 today is not worth $1 tomorrow, right? It's going to decrease in value. So keeping an eye on inflation is important, just to keep in mind that the money that you may see growing may not be the high return that you are actually getting. If you, for example, have an 8% return a year from your portfolio, but inflation is like at 4% on average that year, then you're not really getting an 8% return. It's much lower than that, just because your money is not worth as much anymore. So that's why it's good to keep in mind what's happening with inflation during the year. Next, so annual return. So the annual return is the profit or loss on an investment over a 1-year period. Again, just you want to be checking your investment portfolio. You want to know what's going on. You want to understand the profits that you're getting or the losses that you have that year. Capital gain is the profit that comes from selling an investment for more than you paid for it. So capital gains, that's where the money's at. So if you buy your stock, your index fund at $30, let's say, and then after 10 years, now it's worth $40. Your capital gain would be $10. So the difference between when you bought it and when you sold it. Security is an investment product such as a stock or a bond. You will hear a lot people say securities. I'm buying securities. I have securities in my portfolio. That's what they're talking about. They're just talking about stocks and bonds in the portfolio. So let's talk about them. Bonds pretty much is like turning yourself into a bank. It is a type of debt. When you buy a bond, you're lending to the issuer, which may be the government, municipality, or corporation. So you're lending your money to them for them to do something with it, right? Either to build roads or to research a new product. The idea is that you're lending the money, but just like a bank, you want some interest back, right? You're not just going to be lending people money just because. No, you want that money to make some money for you as well. So you're going to be charging like a small interest on it. And that's how you get your profits through investing in bonds, through that interest that you're going to be charging, basically. So the issuer promised to pay you a specific rate of interest during the life of the bond and to repay you the principal. So you're getting paid the interest plus what you gave them originally, just like a bank does. And this is also known as the bond's face value or par value. And then when the bond matures or comes due after a set period, that's when you get all that money back, your principal plus the interest. So what about stocks? So stocks is basically you becoming part owner of a company. So it's a type of investment that gives people a share of ownership in a company. So if I have stocks in X company, that means I have some ownership from X company. And that means that I am able to get some of those profits, right? That X company is making. So companies issue stock to get money for various things like paying off debt, launching new products, expanding into new markets or regions, and enlarging facilities or building new ones. So they need that money. That's why they issue stocks, and you take advantage of that by buying those stocks and becoming owner and like a part owner to it, and getting some of their profits, getting a cut of those profits that they make every year. So that is stocks and bonds. We're going to take a short break and we'll be back with more information.
The best things in life are the people we love, the places we've been, and the memories we've made along the way. Don't let your pelvic health get in the way of your life. The Pelvic Floor Store, your resource for personal health.
We are back. So we finished talking about stocks. So what's next? After stocks, let's talk a little bit about mutual funds. Mutual funds are a little bit of everything. So a company that pulls money from many investors and invest in money in securities such as stocks, bonds, and short-term debt. They combine holdings of the mutual fund are known as its portfolio, and the investors buy shares in mutual funds. Each share represents an investor's part ownership in the fund and the income it generates. So what does all of this mean, right? So it basically means that when you buy a mutual fund, you are buying a portfolio of stocks, bonds, and or short-term debt. So that mutual fund has all this stuff in it. That's why it makes it a little less risky, because instead of just investing in one company, you're investing in way more securities than just that one company's. So that makes the risk a little bit less. But again, that relationship between risk and reward, you can expect less return if you're just focusing on mutual funds. But again, you have that security in place. And it really depends on your risk taking. If you are less of a risk taker, mutual funds are the way to go. If you are more of a risk taker, then you may prefer individual stocks and bonds. So those are mutual funds. We're going to talk about mutual funds more in detail later on, but we'll leave it at that for now. So another thing that people trade in the market is commodities. So commodities, I'm not a big fan of. I say that you're probably guessing corn prices if you're trading commodities. So commodities are metals, agricultural products, and financial instruments, including U.S. and foreign currencies, and they are traded in the futures market. So commodity futures contracts are in agreements, right, to buy or sell a specific quantity of a commodity at a specific price on a particular date in the future. So again, you're guessing these prices, right? And you're hoping that the price that you guess is less than what you're going to sell it for, and hoping to make that profit. So depending on market conditions on that particular date, people may lose money or they initially invested, or they may make money, right? So it's a very high risk place, but again, it's also high reward. But that's our commodities. So we are gonna watch a very short video on what the stock market actually does and how it works. I think it's very important to watch this video. Again, if we don't finish our presentation, we'll leave that for next time. But this video really breaks down what the stock market is in very layman terms.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises.
So hopefully that gives you a better idea of how the stock market works. So we're gonna do like a little investment game based on that information. As you heard, stock prices really depend on supply and demand and about people's perception of the company. Again, it's a very emotional kind of thing, the stock market. And I think that's something that we don't realize. It's a lot based on emotion. So let's talk about the investment game. So stocks are a type of investment that gives stockholders a share of ownership, right, in the company. They offer investors the greatest potential for growth over the long haul. Again, we're talking about long term. Investors willing to stick with stocks over long periods of time, for example, 15 years or more, generally have been rewarded with strong positive returns. But stock prices can move up as well as down. There's no guarantee that the company whose stock you hold will grow or do well. So you can lose that money that you invest in stocks. So keep that in mind as we move forward. Many factors can affect a stock price, both the positive and the negative. These include factors like faulty product, right? So if there's a faulty product that came out of that company, people are going to lose confidence in that company, the stock price would go down. Also, there could be maybe competition. If there's a lot of competition in the market, if they're not doing as well as our competition, people are going to lose confidence in them. But also maybe they come out with a new product, their demand increases, so their price increases. Sometimes natural disasters also can cause a decrease in stock prices, and there's a bunch of other factors, but that's just an example. Understanding the risk and whether you can afford to take those risks can help you make informed decisions about stock investments. So these are for individual stocks. We have here an example scenario. So here we have Billie Eilish. So we have a celebrity. They're seen using a company's newest gadget. So for example, here's the latest shoe, right? So they have this ad with the latest shoe, and the stock prices to 35 because people are like, oh, the celebrities showcasing this new product. There's probably going to be a lot of demand from the young audience to buy this product. So the stock started at 100, but because the change in perception, a positive change in perception of the company, we have a price increase of $35. So what happened? So when celebrities endorse something, many people want to follow them. The demand for that product increases, and that could mean an increase in sales, which could mean an increase in profits. So again, it always comes down to profits. So if things are good for a company, people are going to assume high profits. So people want to buy that stock. If things are not good for a company, they can assume not so great profits. So they're like, oh, we don't want that stock, right? Because again, stock pays you back in dividends and capital gains. So it might not be the best if they're not doing too well. But in this case, we saw the stock price change to 135 because of this celebrity showcasing that new product from the company. Okay. Next week, we're going to talk more about index funds, mutual funds, because do you really have the time to look at each company and look at each external factor outside to see how that would change and impact your portfolio? Most people don't. We're not day traders, right? We don't have the time to be sitting down on our computer looking at external factors to see how our portfolio would change. So if we don't have time, then maybe the best strategy would be index funds. So next time around, we're going to be talking about index funds and mutual funds. They are interchangeable sometimes. So we're going to talk about VT-SAX and what that looks like and how that kind of dissipates some of the risks that you're taking when investing in the stock market. But that we'll save it for next time. I do want to thank you guys for joining us again this week, and we'll be back next month.